Hello friends, welcome to Stock for Retail. So today we are going to talk about the basics of fundamental analysis. So as promised in my previous video, today we'll be talking about the terms like earning per share, the price to earning ratio, the PV ratio and the dividend yield. These are the basic pointers which can help you identify the undervalued stocks. The stock price reflects all the information that an investor wants to know about a company. So these ratios that we are going to talk about today, right? These will help you kind of filter out the proper stock. So after going through the details of all these factors, you will be in a position to kind of filter out the right stocks for you to invest in. So without wasting any further time, let's get into the details. So the first factor is the earning per share. So earning per share is nothing but a portion of profit which is kind of added to each share held by the investors. So it's actually profit earned divided by the total number of shares issued. So we'll go through an example. So say for example a company X has a total profit of rupees 100 and the total number of shares issued is 20. So the earning per share here in this case will be 100 that divided by 20, so that is 5. Similarly, talking about another company which is company Y, so the total profit of company Y is 300 and the total number of shares issued is 100. So the earning per share becomes 300 divided by 100, that is 3. So out of these companies, which company would you invest in? Company X looks promising. So the next factor is PE ratio. The PE ratio is current share price divided by the earning per share. So let's take an example for the PE ratio. So the company X has the share price of 110 and has the earning per share as we calculated in the previous example is 5. So the price to earning ratio here becomes 110 divided by 5, that is 22. Similarly, we'll take another example of a company called Y whose share price is a little high, that is 300, and its earning per share is 3. So the price to earning becomes 300 divided by 3, that is 100. So based on this, which company would you go for? Obviously company X. So the company Y is actually 5 times expensive than the company X in this case. So now let's talk about the PV ratio. So this ratio compares the stock's market value to its book value. So it's calculated by dividing the current price per share with the book value per share. So we'll take an example for the same. So book value is equal to assets subtracted to the liabilities. So the book value actually depicts the exact proper value of the company. If say for example if the company were kind of supposed to shut today, and if it sold all its assets including the liabilities, the remaining would be the book value. The book value per share will be the book value divided by the total number of shares that the company has. So if the book value per share is closer to the current market price, right, the stock can be kind of termed as the undervalued stock. So let's look into an example. So the company X, the share price of this company is 110 and the book value per share is 120. So the price to book ratio here would be 110 divided by 120, that is 0.91. Similarly, another company has a share price of rupees 300 and the book value per share is 75. So in this case the price to book will be 300 divided by 75, which is equal to 4. So in this scenario, which company would you kind of prefer to go ahead with the investment? So obviously company X, because the company Y again here lags compared to the company X in terms of the PB ratio. So let's talk about another important factor, which is dividend yield. Dividend is actually nothing but a bonus given to the stockholders by the company, and a dividend expressed as a percentage of a current share share price is actually called a dividend yield. So to calculate the dividend yield, divide the annual dividend per share to its price per share. We'll take an example here. So again, talking about the company X, the share price is 110, the annual dividend per share is rupees 4, which it gives to the stockholders. So the yield here would be 4 divided by 110, that is 0.036, and the dividend yield in this case will be 3.63%. So another company Y has the share price of rupees 300. The annual dividend per share that it gives to its stockholders is rupees 4 again, and the yield calculated in this case will be 4 divided by 300, that is 0.013. So the dividend yield in this case will be 1.33%. So again, when we kind of have to choose amongst company X or company Y for a long-term investment, so which company would you prefer? Obviously company X. So here again the company Y lags compared to the company X in terms of providing the dividend yield. So after doing these basic fundamental analysis on company X and company Y, I would kind of decide, rather than suggesting to you, to go ahead with the company X in terms of investments. So friends, this is all I had for this video. So if you are here, you are on the right path to becoming a full-time investor. Please subscribe to my channel and press on the bell icon so that you can get information first when I upload a new video. Thanks for watching.